everybody. Cathie Wood here again, Akreinvest. It's been an exciting month, 2 months, lots going on, markets more volatile, lots of rotation taking place. So we'd just like to share with you what we're thinking. As you know, our time horizon is a 5-year time horizon, but we do have a point of view about the backdrop, the investment backdrop, and we'd like to share those points. So we'll start with monetary policy, fiscal policy, the economy, the market, and just a few thoughts about innovation. So first, monetary policy. M2 is up 27%, so we've seen an acceleration. And this week, just listening to Chairman Powell, Chairman of the Fed, it seems like he's very focused on unemployment, the 10 million jobs still lost relative to pre-COVID, as well as homelessness. It seems, and I've never heard a Fed chairman really focused on homelessness, so a social issue. So for me, that's maybe a little off topic. We all care about it, but what we really want him to focus on is inflation and maintaining economic growth. And I would say if the Fed keeps inflation under control, and I'm not sure it's exactly in the Fed's control anymore, but if inflation does stay quiescent, then I think real growth is going to be fairly strong. We did get some inflation indicators this week, actually today. The PPI came out. It was much stronger than expected. It was up 1% month to month. This is not a year-over-year number, 1%. So annualized, that would be double digit, and that does sound scary. On a year-over-year basis, I believe we're at 4.2%. So we know that we're in the middle of what's called the base effect. Last year, we had declining prices as we entered the COVID crisis. And the declines lasted for several months. So now, year over year, we're going to be comparing against negative numbers. And so on the CPI, we believe, and we've been saying this for some time, that inflation will probably increase to the 3 to 4% range. It was 1.7% in February. And on the PPI, we'll probably see it accelerate on a year-over-year basis to the 6 to 8% range. Now, the Fed has said that it's expecting this. It's not going to react to it, and we believe them, especially given Chairman Powell's focus. And I think the markets are taking this quite calmly. Actually, maybe the anticipation of it caused the huge increase in the long-term Treasury yield from 0.9 at the beginning of the year to 1.75. Perhaps, but when I get into the fixed income markets a little later, we think there might have been something else behind that move. So stay tuned. Fiscal policy. We just got the read on outlays for last month, up 63%. Federal outlays up 63% on a year-over-year basis. And the deficit is annualizing at about $4 trillion. So that's quite a significant deficit. And clearly we're going to see a continued increase in the deficit because now President Biden would like a $2 trillion infrastructure bill. So we've just begun. We've never seen spending like this so consistently, from crisis spending to infrastructure spending. And we know we're going to have to pay for this somehow, sometime. I think that the markets are going to enter a very confusing period as we try and sort this all out. One of the responses to the deficit, of course, is talk about taxes. What we're seeing so far is more on the corporate side in terms of proposals that are being taken seriously, at least. The corporate tax rate going from 21% to 28%, it doesn't seem like it will go up that much. The compromise seems like it's going to center on 25% with a disproportionate hit to companies with branches abroad, so foreign taxes. And so the incentive, of course, is to bring more business back home. On the individual side, we know that the aim there is to focus on the wealthy, over $400,000 in income per year. And we'll see how that plays out. I think what is shocking to many of us is what some states are doing in terms of taxes. So I think the migration from the high tax states like New York, Connecticut, New Jersey, California, I think the migration that COVID sparked, I think that's going to accelerate. And I think there's going to be some real turmoil in the states that are no longer attracting capital or people. So I think New York State this week proposed a 14.8% tax. That would be the highest in the nation and a real turnoff. We've seen the exodus from New York and Connecticut to Florida. We're getting a lot more evidence that this is accelerating. And even ARC itself is thinking about alternatives. So I think that's something to watch. On the economy, so February, if you look at the statistics from February, you would have said, oh my goodness, we're going back into the soup. And yet what we've seen in March data, early March data, is we're rebounding nicely from what now appears to have been a weather-related hit. And it was hard, especially given the difficulties in Texas. So we're rebounding. In fact, if you look at the Philly Fed, that's the very first indicator that comes out. It's an indicator of real economic activity, volume growth. And that has not been this strong since 1994. Think about that, 27 years ago. So we're not in uncharted territory, but the rebound that we're seeing here is enormous. And I think it's a reaction to supply chain issues. I think we should start worrying about double ordering, triple ordering, and ultimately an inventory problem. But so far, we're nowhere near that. This kind of environment, though, does elicit that kind of behavior. Employment, the employment report, which is the first major report, much stronger than expected. The expectation for non-farm payroll was an increase of 660,000, and the actual increase was 916,000. What's more as interesting to me is at the same time, the average work week went up significantly. Normally, first of all, it rarely changes. When it does, it's usually 0.1 hours in any given month. This last month, it was up 0.2 hours. So I think that companies are, again, still scrambling to keep up with demand. And we're now seeing that demand is getting another push from the stimulus check. So in February, the saving rate dropped significantly to a little over 13%. But we think that was temporary and that it is going to go back above 20%. So again, the consumer has a lot of firepower here. And we're also seeing shortages. Labor shortages crop up. I know that Chairman Powell is worried about employment, and I I do believe there has been a lot of displacement, but something called the JOLT index, it's a job openings index, it is now near a record high. So the record high was in November of 2018, and that was 7.6 million jobs unfilled. Either there's a skill mismatch or they're not paying enough. And at the low last year, it was 4.8 million. So even that was high by historical standards. So I think we are going to start talking about labor shortages and fears about wage inflation in the near future. So that's an interesting dynamic. I think the summary of what's going on in the economy is that we're in a V-shaped recovery. I don't think there's anyone debating that anymore. And excuse me. The question we're facing more now is on the cost side, margins. Is labor inflation going to pick up in response to these shortages? Taxes are going up. That's an automatic. Debt service is probably going up. Spreads in the bond market, meaning the difference between high quality company yields and lower quality company yields was a very narrow spread. And we believe that is going to change given the confusion and turmoil. And of course, the other cost factor here is materials. Commodity prices have been soaring. One of the dampeners out there in terms of inflation is the dollar. It is doing what I think many did not expect. It's going up. So that's a counterforce against inflation, as is productivity. With strong growth in a V-shaped recovery, we will see strong productivity gains. So those two will be fighting inflation, whereas labor, taxes, and interest rates and material prices will all be tending to dampen margins. So it'll be a dueling match here. We'll see what happens. Adding to the confusion, and you've heard me speak of this before, is the deflationary impulse that we see coming out of inflation. That's good deflation, and it's going to stimulate unit growth, which again is reinforcing in terms of productivity growth. There is also bad deflation at work. And we think the bad deflation is going to hit those companies that are in harm's way because of innovation. So this is the creative destruction that we're talking about, and especially those companies who have not prepared for the new world and have really tried to satisfy very short-term oriented shareholders. And what that meant is after the tech and telecom bust and the 08-09 meltdown, shareholders became very short-term in their focus. They wanted their profits and they wanted them now. They wanted their dividends and they wanted them now. And so what a lot of companies did to satisfy those shareholders was leverage up, actually take on debt in order to buy back their shares and keep their earnings growth going, earnings per share. They also did that to pay dividends. And they were not investing enough in innovation. And so what we're going to see out of those companies, maybe not this year, but over time, is deflation, the bad kind. They're going to have to cut prices to move inventory that is going to become obsolete anyway. And they'll have to cut prices to service their debt. Other companies who are on the right side of change and have prepared for the new world are going to do very well indeed. So I think the markets, the equity markets and the bond market are going to become confused at these dueling forces. And we're going to be here to help explain, as we see it, how these forces are going to evolve and who's going to win out in the end. Now, in terms of markets, the fixed income market, as I mentioned earlier, we saw a backup in yields from 0.9 to 1.75 in a little more than 3 months this year. And in the bond market, that kind of move, nearly a doubling, think about that, is massive. And we've been very gratified to see the equity market kind of power through it. The equity market, I believe, has looked at it as, hey, this is the market working. The economy is very strong on the mend here, and there is a risk of inflation. So very natural to see this happen. The bond market players, I know, have been quite shocked at the move. One of the things that surfaced, and I haven't heard anyone speak about this, I've seen very little written about it, something called the SLR. It's a capital ratio that financial services institutions have to abide by. During the coronavirus, the Fed gave banks leeway and said, okay, you can count long-term treasury securities in your capital ratios to help you out here. Well, what I didn't know until a week before that leniency ended was that it was going to end March 30th of this year. And there was a little hullabaloo over it. There were some politicians saying, don't give the banks any more breaks. And so it did end. And lo and behold, interest rates seem to have settled down here a bit. Could it have been that banks were big sellers in the first quarter of treasury bonds and drove the treasury yield up much faster than normally would have been the case? It may have been so because we've come down from that 175, not very much, but a lot of economists were saying, oh, straight on to 3% or straight on to 2.5%. I think a big surprise and a support for the equity market here is it hasn't continued. What we've also seen in terms of excitement is the Archegos drama, for want of a better word, and that was just the case, it seems now, of one entity leveraging up far too much, with one bank not knowing how much exposure other banks had to the same firm. And it seems to have been an isolated event. Again, we've been quite reassured at by the equity market's reaction to that accident. It looks like it was a real accident. Because if risk departments around the world had said, okay, cut down on all of your risk, that would have been a recipe, the combination of interest rates going up the way they did and the Archegos leverage cascading into decision-making by risk officers. That didn't happen either. So these have been battle tests for the equity market, and I have to say, the equity market has done very well. Now, the rotation that we talked about last week is still well underway. Last month, still well underway. We are still seeing the market favoring cyclicals and value, but growth is clawing its way back. So if you'll remember the last time I talked about this, excuse me. So we said last month that this rotation was a very healthy thing because it meant the bull market was broadening out. And I think the two examples I just gave you, overcoming those, is another battle testing. So we're very optimistic about the equity markets. And the way to look at this rotation is the market's broadening out, but it is going to be another launching pad for growth strategies. At some point, the market will recognize we've seen the biggest cyclical burst in earnings, and it will look for growth once again elsewhere. And of course, innovation is a great source of growth. We are also seeing energy, the top performer, up 27%, and financials, the second, 19%. And as I mentioned last month, that's almost reassuring to me and us, because those two sectors, we believe, are going to be disrupted, if not the most, almost the most, relative to other sectors. So the confusion that I mentioned a little earlier, deflationary forces, cost pressures, and so forth, are probably going to hit them pretty hard. It doesn't have to be in the next 6 months, but the market is a discounting mechanism, and we believe the market will start to look at some of those indicators. So we are gratified to see growth beginning to engage once again, and we think in a good, strong market that will continue. Now, there is one thing I'd like to address before I finish up here, and that is we put out a podcast on our big ideas. Brett Winton and I had a conversation. Brett is our director of research. And Big Ideas 2021, if you haven't seen it, please go to our website, arc-invest.com. I think it's the best piece we put out all year in terms of giving investors a very broad view of the opportunities that we see evolving from the exponential growth trajectories that the 14 technologies around which we have based all of our research and which are supporting the 5 major platforms. So we laid those out in the podcast, and Elon Musk responded to us and asked the question about, I guess it's the Warren Buffett indicator. I didn't know it was called that. But it is a ratio, the equity market cap in the U.S. To GDP, which is as high as it's been really with the exception of the tech and telecom bubble. But if you go back about 100 years, this is about as high as it gets. And so we've done a lot of research on not just the past 100 years, but prior to that as well, because the past 100 years, and especially post-World War II, where we have the best statistics, they've been good guides, the highs and lows, the bases and so forth. But we're in a new era, and it's much more like the late 1800s and the early 1900s. And if you look at that same ratio back there, it's much higher, much higher. And I think one of the reasons for this is the denominator. GDP is made up of both real growth and inflation. And if we're right, and these 5 major platforms, 14 technologies, are all deflationary in nature, and they're going to become a bigger part of the economy. Think electric vehicles going from 2.2 million sales globally last year to 40 million in 5 years. And we think the growth in the US is going to be as fast as that 82% compounded at an annual rate. If that's right, and these major deflationary forces begin to move the GDP needle, it means the denominator is moving down. All other things equal, to say deflation pulls the denominator down relative to the numerator. And that means the ratio is going up. So I think you do have to go back to the last time we saw major innovation platforms evolve at the same time. There were only 3 back then: telephone, electricity, and automobile. There are 5 now: DNA sequencing, robotics, energy storage, artificial intelligence, blockchain technology. And they are going to deliver profound changes in the global economy. Deflationary forces of 5 innovation platforms are going to be powerful. And then add on top of that the deflationary forces associated with companies that have not done the right thing over the last 20 years. Those two are going to be tugging at GDP, and I think pushing that ratio higher. And when you think about it, if we're right on this deflation call, then the long-term treasury yield probably is not going to go much above 2.5% or 3%, if we're right. And that suggests that the valuation of the market could be somewhere in the 30 to 40 times. It sounds crazy, right? Right now, we're roughly 20 times, a little more than that, maybe, prospectively. But the idea that it could double sounds crazy, and I agree with anyone who thinks that sounds crazy. But there is a possible rationale out there. Are we betting on it? We are not. We have a 5-year time horizon, and when we slap a multiple on the 5th year, we are using really normalized for what we're seeing today. We're assuming that many of these technologies look like they're mature at the end of year 5, when in fact they probably will not be. We're just trying to be conservative. And so, as I mentioned last time around, for those of you who have been concerned about the volatility in the market, the volatility in our strategies, all that did from our point of view is give us bargain prices so that we started once again to concentrate towards our highest conviction names and got some great opportunities as the rotation into value was taking place. It was taking place out of names like ours. And we will use those opportunities every time, because our price targets are not going to change. These long-term price targets are based on well-defined cost curve declines and the price elasticity of demand estimates. If we get a change on either one of those, then of course we'll adjust. But a volatile market is not going to change anything in our 5-year targets. So we're very excited about the equity market and also innovation. We love the fact that we're engaging on Twitter with Elon Musk and lots of other executives and investors and innovators and individuals. And we love getting those sorts of questions. We need to stay on our toes. That's what we intend to do. And so with that, I'll wish you a very happy spring weekend.